I'm Terry Baughman, Vice President with the Bank San Juans. We are here today to present FDIC's Pay Yourself First. So we're going to talk about some really cool ways of managing your money, kind of a follow-up to our first presentation from setting financial goals and taking you to the next level.
Hi, and I'm Stacy Harner. I'm a branch manager with Bank of the San Juans, and I'm going to go over the objectives for today. So today we are going to explain why it's important to save, determine goals for saving money, identify savings options, determine which savings options will help you reach your savings goals, recognize which investment options are right for you, list ways to save for retirement, and list ways to save for large expense goals.
So let's think about this. What do you know or want to know and learn about saving money? I think that's a really good question. I think that as I was growing up and learning and thinking about how to save money and what the best tools were, I wish that I would have had some additional guidance and some ideas on how to save money. And so today we're really going to work on that and help you get those tools to save money. So let's get started first with our pre-test. So this is going to give you an idea of what you may or may not know about paying yourself first. So let's start with question number 1. Select all that apply. And I apologize, this would be in your workbook on page number 4. All right, so number 1, select all that apply. Paying yourself first means A, putting some of your income into a savings account before paying bills. B, buying personal items before paying bills. C, putting money in a savings account if there's any left after paying bills. Or D, putting tax refunds or cash gifts in a savings account before spending the money. The answer is A, putting some of your income into a savings account before paying bills, as well as D, putting tax refunds or cash gifts in a savings account before spending the money.
All right, number 2. Saving is important so that you can A, have money for emergencies, B, achieve your financial goals, C, manage your money better, D, improve your standard of living, E, both A and B, or F, all of the above. And you would be correct if you picked F, all of these.
All right, number 3. Which of the following are ways you can save for retirement? I know it might feel like it's real far away, but it's a great idea to start saving while you're still young for retirement. So let's select all that apply. A, build home equity, then apply for a home equity loan. B, invest in stocks, bonds, or mutual funds. C, establish a 529 plan. Or D, enroll in a 401k or a 403b plan. The answer would be B, invest in stocks, bonds, or mutual funds, as well as D, enroll in a 401k or 403b plan.
Number 4. Which of the following are good strategies to apply when selecting the savings or investment option that is best for you? Select all that apply. A, select one product to save and invest all your money. B, choose savings investment products that match your risk tolerance. C, trust others to give you good investment advice. Or D, reevaluate your savings investments periodically. And you would be correct if you picked B, choose savings investment products that match your risk tolerance, and D, reevaluate your savings investments periodically.
Number 5, what should you consider when establishing goals for saving money? Select all that apply. A, the amount of money you want to save. B, the time frame of when you need to access the money saved. C, ways you can cut spending and save. D, the annual percentage yield of different savings products. Or E, all of the above. The correct answer is E, all of the above.
Number 6. Which of the following would be considered a need rather than a want? Select all that apply. A. Paying your rent or mortgage. B. Buying new clothes on impulse. C. Eating out at restaurants regularly. Or D. Getting the maximum largest plan for your cell phone, cable, etc. And the correct answer for 6 is A. Paying rent or mortgage.
Number 7. Which of the following will help you save money? Select all that apply. A. Pay your bills on time to avoid late fees or extra charges. B. Consider opening a checking account rather than using a check cashing store. C. Make impulse purchases. Or D. Save your change at the end of each day. The correct answers would be A. Pay your bills on time to avoid extra fees. B. Consider opening a checking account rather than using a check cashing store. And D. Save your change at the end of each day.
All right, number 8. APY means A. The amount of interest you pay on a loan. B. The annual interest rate you will earn on your savings or other deposit account. C. The minimum percent of your income you must save each year to keep your savings account. Or D. To be careful you are getting the correct amount of interest on your savings account. And the correct answer for number 8 is B. The annual interest rate you will earn on your savings or other deposit account.
Great. Now that we got through the pre-test, let's dig into the details about Pay Yourself First. So if you will get on your workbook page number 6, and let's review some of this information. So Pay Yourself First. What does it mean to pay yourself first? It means putting money in a savings account before you're paying your bills. If you set aside the money right from the beginning when you get paid on your payday, then it's money that you will never miss. Or, like we talked in our previous module, just automatically having your bank take the money out of your account and putting it into a savings product. Why would you want to save money before paying your bills? It's a good idea to do that because you count it as a bill for the month. So if I decide that I want to pay $25 to my savings account, I'm really paying a bill to my savings account so I can start savings for the future. And what are some of the things you might want to save for? There's a variety of things that you might want to save for. Maybe it's a car, maybe it's a home. Depending on your stage of life, it could be a variety of things. And we'll talk a little bit more about that as well. So even maybe talking about some major expenses that people have to save for might include unexpected events. Maybe you lost your job or had car repairs or unexpected medical bills. These are things that typically we don't think about ahead of time because we're not expecting these things to happen. So we want to make sure that we do pay ourselves first so that we have some money set aside for these unexpected expenses. How about, just like I mentioned earlier, a down payment for a house, a car, or any other larger purchase that you may need? Again, setting some money aside for those items are going to help you to get there. How about education? And I know many of you are probably have maybe your parents have put some money aside, or you maybe put some money aside for education. And then retirement. We need to be thinking long ahead before retirement because those years go really quickly. And while you're young, it's a great idea to look for some retirement tools so that, again, pay yourself first for those years ahead. And then vacation. We all need some time away. And what better way to have a vacation, and maybe a nice vacation, by setting aside some money. And that might mean that maybe you don't take vacation this year. Maybe it's a 2 or 3 year plan, and it's a really nice vacation. And by saving ahead, you can take that really nice vacation. Let's turn to workbook page 7. And we're going to talk a little about an exercise that we're going to put together. But I'd like to first have Stacy talk a little about some savings tips to help guide us through these next 2 activities.
So some savings tips to think about as you're filling out this worksheet include considering needs versus wants. Think about the items you purchase on a regular basis, then add up. Where can you save? Do you eat at restaurants a lot? Can you cut back on daily expenses? Do you have services you do not really need, such as cable television? How about using direct deposit or automatic transfer to savings? When you get paid, put a portion in savings through direct deposit or automatic transfer. If you have a checking account, you might want to sign up for money to be moved into your savings account every month. You may purchase United States savings bonds as a payroll deduction. Or how about paying your bills on time? This saves the added expense of late fees, extra finance charges, disconnection fees for utilities. Fees to reestablish connection for service is disconnected, the cost of eviction, and repossession. Consider opening a checking account at a bank or credit union instead of using check cashing stores. You might pay 2% or more of each check you cash. 2% of a $500 check is $10. This can easily add up to several $100s in fees every year. If you would like more information about checking accounts, you can take the Check It Out. You can take the Check It Out module. Put some money in savings accounts if you get a raise or a bonus from your employer. Keep making the monthly payments to yourself once you have paid off a loan. That's actually a really great idea. Instead of using the money to go spend on some other thing, once you pay off that loan, take that payment that you've made every month and put it into your savings. You can invest the money for future goals. Save at least part of any cash gift that you receive from family for birthdays, etc. Avoid debt that does not help long-term financial security, including loans for vacation, clothing, and dinners at a restaurant. Examples of debt that help build long-term financial security include paying for college education, buying or remodeling a house, buying a car for work, for transportation. Pay off high-interest credit cards or other loans as soon as you can. Save your change at the end of the day and deposit it weekly. You'd be amazed how much loose coin adds up. Save as much of your tax refund as possible. And just join a retirement plan. If your employer offers one and deducts the money from your paycheck, most employers will match up to 50 cents of each dollar you contribute. The matched amount is free money.
These are great savings tips, and I encourage you to really hang on to this page and think about these items. I know that Stacy went through them, but there's some great tips and tools for you to use on this page. This savings tip page is a really great tool for you to use in the future. So make sure that you hang on to that page. Let's go ahead and look at activity 1 on your workbook, page number 7. So when we're talking about pay yourself first, again, think about and write down any savings goals you have in the amount that you need to save. So for Stacy and I, we kind of put an idea together that we maybe needed a new car. We'll need to set aside $3,000, and another goal of mine would be to pay off my credit cards, and those are about $250.
Strategies to save for our goals. We could cut out Starbucks.
No, that might not be the best idea. But if we have to.
Well, Terry, if you spend $4 a day on Starbucks at five days a week, that's $20, which can add up to about $80 a month.
Well, when you put it that way, you're right. I guess I can give up a couple of days of Starbucks, Stacy.
How about don't eat out for lunch? Pack a lunch. Take your lunch with you. And you might have to cut out getting your nails done.
She's putting a lot on me, Starbucks and nails. But when we think about it, those are expenses that we really could put to better use for sure.
You could also take your weekly pizza night and make that every other week. Or you could have a family fun night and make your own pizza.
That would be a lot of fun.
So let's talk about interest. Interest is an amount of money financial institutions pay you for keeping money on deposit with them. It's expressed as a percentage, and it's calculated based on the money in your account. Compound interest. You earn money on previously paid interest and the money in your account. Interest can be compounded daily, monthly, or annually. So let's take a look at annual versus daily compounding. So on your workbook page 9 at the bottom, we'll kind of go through this so you can see the differences. So annual compounding, you start with 1,000 at 1% compounded annually. At the end of the first day, you still have $1,000. At the end of the year, you have 1,010 minus 10, or 1% of 1,000 is added to the original deposit.
If you did daily compounding, you start with $1,000 at, again, the 1% can compounded daily. At the end of the first day, you have $1,000.03. On the second day, you add the interest earned, the 3 cents, and compound that total amount with the $1,000.03. At the end of the year, with this daily compounding, you would have $1,010 and a nickel from compounding each day's interest from that original $1,000. Stacy, when we look at that, you can absolutely see that the annual compounding at the end of a year is $1,010, but the annual income for daily compounding would be $1,010.05. So it's really important when you're meeting with your banker or anywhere that you're looking to save your money that you understand and ask the questions, how is this interest compounding? Is it annually? Is it daily? Because you can see from this example, it does make a difference.
So on page 10 of your workbook, this kind of gives you some different scenarios of different amounts that you can save. And you can see the differences between just saving on your own and having it someplace where you could earn 2% daily compounding. So if you saved 50 cents a day for 1 year with no interest, it would be $182. 2% daily compounding would give you $184. So go clear down to year 30 with no interest, it would be $5,460. But 2% daily compounding gives you $7,480.
Wow, that's amazing.
That is amazing. Savings $1 a day, year 1, $365. 2% daily compounding, you'd have $368. And year 30, you'd have $10,950. But 2% daily compounding would give you $14,960. And if you saved $5 a day, year 1 with no interest, you'd have $1,825. 2% daily compounding, you'd have $1,838. But at year 30, you'd have $54,750. With a 2% daily compounding, you'd have $74,798.
This is really, again, some information for you to really consider when you're looking at a savings plan. Making sure that you're putting your extra dollars into a product that actually gives you some interest. And looking at the daily or annual compounding, again, like we just spoke about, is really important. I think this sheet right here is really interesting when we take a look at a 50 cent a day or $1 a day or $5 a day. So the more money you make, the more you should make sure that you put into savings, and you can see over 30 years how quickly those dollars will grow with the daily compounding situation.
So let's take a look at annual percentage yield, APY. This is the amount of interest you will earn on a yearly basis expressed as a percentage. This includes the effect of compounding, should be used to compare savings products, not the interest rate. And on page 11 of your workbook, there's also a rule of 72. This is a formula that lets you estimate how long it will take for your savings to double in value. 72 divided by 4% equals 18 years. The interest rate needed to double your savings within a set time period, 72 divided by 12 equals 6%. So if you want your savings account to double in value in 20 years, what interest rate would the account need to have? So you would take 72 divided by 20 equals 3.6%.
Again, this is a great tool for looking at where should you put your money and what kind of interest rate should you be looking at. The rule of 72 is just an amazing way to take a look at if I need to save for the next 20 years, what kind of rate should I be looking at? So make sure that you think about this. The rule of 72 is an easy calculation, but it's a great way to figure out what kind of interest rate do I need to use or earn on my savings to grow those dollars.
We're going to look at some savings options. So there's two basic ways to save money. One, opening a savings account. These are federally insured by the Federal Deposit Insurance Corporation. Or two, you can invest your money, which is not federally insured and you can lose value. So we're going to name the savings product. So which account would you be able to leave your money for a set period of time or term? You cannot make deposits or withdrawals. You can earn a higher interest rate with longer terms, and you can pay a fee if you withdraw your money before the term is ended. This would be a CD, a certificate of deposit.
And let me try to explain this a little bit more in detail. The thing about a CD is the fact that when Stacy talks about leaving your money in there for a set period of time or term, it's really a promise to the bank to say, I am going to leave this $500 in your bank for a year, and you're going to pay me this additional interest rate. So usually CDs are a great tool if it's some dollars that you want to see earn some additional interest on rather than a savings account. A CD is a great product to say, I'm going to leave it in there for 6 months or a year. I'm going to get additional interest on it. Now remember though, if you have an emergency and you need to withdraw that CD, there is going to be a fee. And the reason is because you promised to leave it in there for a year. But if you need to get to those dollars, you can. There just would be a penalty on those dollars.
All right, so which account requires a higher minimum balance to earn interest, usually? Pays a higher interest rate for higher balances, does not have a fixed term, and allows you to make deposits and withdrawals. This would be a money market account.
Let me explain a little bit more on that too, as Stacy kind of shared that information with you. So a money market product is kind of like a checking account. You are limited to the amount of withdrawals you can make from it, but typically the higher amount of dollars that you have in that account, the higher interest you'll get on that account as well. So it has more flexibility than the certificate of deposit, and it can be used sort of as a checking account with some limitations. So again, another great tool to earn a little higher interest, but a little bit more restrictive.
So what account pays interest on your balance, may require you to maintain a minimum daily balance, and requires a lower minimum deposit to open? This would be a savings account. So we're just going to go over a few other types of accounts. So individual development account, or they refer to it as an IDA, is a matched savings account. It helps low-income families save money and become financially independent. The uses for this account are job training, college education, small business startup, and home purchases. An IDA is usually run by a local community-based organization, and you can ask your local community action agencies or community groups for more information on this kind of program. An electronic transfer account, also known as an ETA, is a low-cost account. It allows federal payment recipients to receive their payments through direct deposit. The features include a monthly fee of $3 or less, no minimum balances, and a debit card for point-of-sale transactions may be offered. A 529 college savings plan. This is an education savings plan. It's operated by the state or educational institution. It's designed to help families set aside funds to pay for future college costs. There are two different types. There's a 529 prepaid tuition plan and a 529 savings plan.
So let's make sure that we're on page 14 of your workbook and talk a little bit about some investments. I know this is an area that many ask about because if we have some additional dollars that we can use for investments, there's some great tools and some great information. So, an investment is a long term savings option for future income or financial benefit. These investment products are not federally insured. And so, what that means is when you put your money into a bank, and I think we talked about this a little bit ago, when you put your money into a bank, FDIC insurance is there to protect your funds. When you use investment products, there is not a protection for those funds. So, you want to make sure that you're really looking at what kind of risk you can take with those kind of things. So, you must weigh the risks and returns, and you earn money by selling the investments for more than you pay. That really is the goal of investments. And then receiving dividends and interest earnings on those investments. So before you invest, save at least 6 months of savings cushion. So your bank or a financial advisor or an investment firm can kind of work with you and help you and talk through what would be the best way for me to invest, making sure that you've got some money set aside for that investment. So also, your employer offered retirement accounts. Those are great options for you depending on what what employer you might be working for that has an offering for retirement account. Anywhere you work, if they have an employer offered retirement account, please check into it. Many times, some of the dollars that you put in, they're going to match those dollars. So that's free money. So make sure that you're asking when you, maybe even when you apply for a position, if there's any type of retirement account for that company. And do some research. Make sure that you take the time to do research on those investments. You don't want to lose any money, but you also want to make sure that you're being very prudent about where you put those dollars. So here are some more investment products, and we'll talk about these a little bit more in detail as well. There are bonds, mutual funds, retirement investments, stocks, and U.S. Treasury securities. So we'll talk about these in a little bit more detail. When you're looking for the best investment, learn as much as you can about the investment. From financial magazines, a plan administrator, do some homework. Remember that past performance on a specific investment is not always a guarantee of the future investment. So make sure you keep that in mind. Consider how long you might want to keep your money in that investment. If you invest over time, you are more able to ride out the ups and downs of the stock market. So make sure that you're considering that you're going to hit some bumps in the road and you're probably going to take some losses. But over time, hopefully where you've put those dollars are really going to grow and be a great investment for you. Diversify. Again, talk to a financial investor about this. You should have a mix of investment products that reflect the needs for return, safety, and long-term savings. Make sure that you look at diversifying those funds. Reevaluate your investments from time to time. So most of the time you may receive a quarterly statement on your investment. Make sure you take some time to go over that. Maybe talk with your financial advisor and say, hey, I see that this specific investment isn't performing very well. What should we do? How should we consider moving this? Or should we write it out? And they should give you some great insight into that as well. Determine how much risk you're really ready and willing to tolerate. Remember, there's a trade-off between risk and return. There's some additional information before investing. Ask your employer about a retirement plan, just like I mentioned before, and then learn about investment options from your bank's customer service rep or a reputable financial advisor. Most of the time, the financial advisor is going to be the person that you could really talk to look for some different options on investing. The bank has CDs and savings and money market products that are going to earn a little higher. Remember that they're FDIC insured, so you're not going to have any risk with those. But with a financial advisor, make sure that you're understanding what those risks are and what that might look like for you. You can always get some reliable sources from the IRS. So if you go to the irs.gov website, it'll give you some good information on those specific examples as well. Let's talk about owning a home. This is a great investment. So owning a home is an investment over time, and the house generally increases in value. So equity is the difference between how much the house is worth and how much you owe. So for example, if the value of the home that you own is $250,000 minus the debt, so you have debt on the home that you owe $200,000, your equity, or what you have equity in the house, would be $50,000. So owning a home is another great investment, and over time it can help you build your financial security as well. When we're looking at ways to save for retirement, ask yourself these questions. When do you expect to retire? And you're never too young to think about that. I know that, I have my sons are in their 30s. I have one that just recently turned 40. And they themselves have been thinking about retirement and where they need to be in the future. And so really think about that, because time gets away from us. And before you know it, you're looking at retirement. And did you save enough for retirement? Will you continue to earn income from a part-time job when you retire? How much money do you have in savings and pensions when you retire? And what expenses will you incur for housing and health care at retirement? So these are great things that make sure that you're looking for and asking these questions when you're looking for retirement. I know that it seems like it's a really long way away, but make sure that you consider some of these ideas as well. Let's talk about how to create a savings action plan. And you need to consider these decision factors. Stacy talked about the rule of 72. So how much money do you want to accumulate over a certain amount of time? Using the rule of 72 should help you figure out what kind of rate you need to earn for that time period that you want to save those dollars. And how long can you leave your money invested? If you have money in different investment options, you want to make sure that you understand if there's a time frame on those investments, or if you can leave those for eternity. And then how do you feel about risking your money? I promise it doesn't feel good when you hit that bump in the road and you lose some of your investment when you're investing. But over time, you'll see that it comes back most of the time, and you just have to write it out. And that's what we've all had to do when we've done some investing.
So Terry, let's play Name the Investment Product.
Well, right. I would love to play that game with you, Stacy. Let's go.
Okay, so when you loan money to a corporation or the government for a certain period of time, when you own a share, part of the company, you might receive periodic dividends when the company makes a profit. What is this investment product?
So this really is corporate bonds and stocks. And I want to share a little story about an incident that happened to me. I currently work for Bank of San Juan, but previously we were Canyon National Bank. And so when Canyon National Bank sold, I had some stock in Canyon National Bank. So when it sold to Glacier Bank Corp, I got a substantial amount of money from that stock. In addition to that, I left some of that stock in Glacier stock. So what that means for me is now, every quarter, as long as Glacier Bank does good, and they've done very well over time, I get a little dividend check. And so I'm able to put that aside into my savings. So when you talk about looking at some additional ways to save money, maybe that's a company that you work for that you want to buy some of their stock. And many times an employee can get some discount on that stock, but it was really surprising to me. I never anticipated that Canyon National Bank was going to sell. And when it did, although I was sad to see, us move into another organization, but this organization is fabulous, so I'm not sad. It was just kind of scary at first. But the amazing investment that I made with a very small amount of money really was a great investment for me. So just think about those things. Again, I didn't plan for that. I didn't intentionally get stock in Canyon National Bank so that knowing that was going to happen, but it was something that did happen for me. And now, every quarter, I get a dividend from Glacier Bank.
So Terry, when you loan money to the government, you can select from products based on their face value and maturity date. And 4, when you invest money over a long period of time so that you will have money to live on when you are no longer working. What is this investment product?
So these investment products is the U.S. Treasury securities, and so that's backed by the government. And so those are, for the most part, very secure products to invest in. And then retirement investments, and there's a variety of different retirement investments to look at and discuss as well. And we'll talk a little bit more about those as well.
And Terry, what product allows you to invest in many investors in investment products?
Mutual funds. And that's kind of where, those are kind of pooled together investments that you hope are all going to work together. And those are mutual funds is another good one to look at as you're looking to save. Let's talk a little bit about savings bonds. So I remember when I first got into banking, I've been in banking for over 35 years, so interest rates were really, really high. And so what that meant was on the savings side, it was great because you could get a CD and those rates would be sometimes 15%. Those days are long gone. Now I hope someday it comes back around, but those were the days where people really invested in different savings products, and savings bonds were a great place to put your money. At that time, double E bonds, usually they would double in their face value within 18 years. Now, because rates are much lower, it does take a lot longer for those bonds to mature. But these are great ways to, again, save and purchase some bonds. You can purchase bonds electronically. You purchase them at face value, and I think that they're great ways to kind of look at ways to kind of save money. I know that back in the day, my grandparents actually bought savings bonds for all the grandkids, and we saved those over time. You do have to be paying attention though, because those do mature, and at that point, then you have the option to cash those out. On page 15 of your workbook, it talks a little bit about the U.S. Treasury securities. And so there's different options. Again, those are backed by the U.S. government. So there's T-bills, there's Treasury notes, there's also the Treasury inflation protection securities, as well as Treasury bonds. So those are great tools, and I encourage you to go on the website and kind of look at those different Treasury opportunities. They are backed by the U.S. government, so they're mostly secure as well. On page 16 of your workbook, corporate bonds. So corporate bonds are loans to a corporation for a certain period of time. So what that means is that, say, School District 70 wants to build a new high school. So they may reach out to the community, and people can go in and purchase bonds to help with that building of that school, or maybe even addition to a library. There's opportunity to get some corporate bonds, and then you do get repaid, and it's lent for a specific time and date on those for sure. Also on page 16, we talk about stocks, and so this is where you would probably want to get with a financial advisor. You own a share and a part of the company, just like I do with Glacier Bank Corp. You receive dividends, just like I do. And then the value of your investment goes up or down depending on the stock market. So just watching those things as you purchase those stocks. Mutual funds, again, is a product that combines money with many investors. So it's a pool of funds that are gathered together. It includes stocks and bonds, so there's a mix. It can pay dividends depending on how that mutual fund is set up. And then it changes again. It also changes in value with the stock market. So when we're talking about these different areas to invest, we talked a little bit earlier about diversifying and kind of spreading that risk out so that you don't have all of your dollars in the same bucket, if you will, so that you're not going to lose everything if that specific option crashes. So make sure that you diversify. And again, I encourage you to talk to a financial advisor to help you look at what kind of risk you can tolerate and what might be the best for you. As we continue to look on workbook page number 16, we can talk about IRAs. So IRAs are individual retirement arrangements, and they can sometimes include a combination of investment products. That's usually done through your financial advisor. They're tax exempt, so you want to pay attention to that depending on how you're investing those dollars. They, again, can fluctuate with the stock market. You can purchase traditional IRAs and Roth IRAs, so there's different IRA products out there as well. Banks also offer IRAs, and so we can help set up an IRA. Those are not an investment product. Again, making sure that you understand that anything you do as an investment with a bank is always FDIC insured. So you're not going to ever lose a dollar on any of those investments. Where if you open an IRA with a financial advisor, again, there could be some risk. But I want to encourage you to make sure you weigh those options because, again, if you do it while you're young, you might get a lot more return than you would if you let it sit in a bank's IRA. Page 17 talks about employer investment and retirement plans. Again, a 401k and a 403b plan, those are established by your employer. You designate a percentage of your pay to be taken out pre-tax, so it comes out before your tax. And then many times your employer may offer a matching contribution. I encourage you strongly, if your employer offers this plan, you got to jump in right away. Day one, sign up for 401k because it's free money. It is protected, and well, I shouldn't say it's protected. It depends on how those are also put into different plans. But talk to your HR to decide how they designate those. And then a 403b is offered to employees that are with public schools or certain tax exempt organizations. But I can't tell you enough that you should take a look at 401k and 403b plans with your employer because it's a great opportunity for you to grow your money. Again, variable annuities is an insurance contract that invests your premiums in various mutual fund-like investments. So remember, mutual funds are kind of a pool of different investments. So you want to look at those variable annuities and kind of look at how they're doing as well. Variable annuities can be very costly due to fees. So you want to make sure that you're asking questions about any fees that are related to investment. And then they might have high annual fees. There's surrender charges on early withdrawals. There's a tax penalty if you withdraw before the age of 59 and a half. And then life benefit guarantee fee. So really make sure that you're doing your homework like we've said today when you're looking at different types of annuities or any mutual funds or things that you're investing in. Make sure that the financial advisor talks about the cost because it's important for you to understand that as well. So how do you choose the best investment? Here's what we're going to talk about. You need to learn as much as possible, so make sure that you do your own homework. Consider how long you plan to keep your money in the investment. So over time, how long do you plan on investing? If you're young in your 20s, most likely you have 40 plus years of retirement and investing. Make sure that you diversify, again, because you want to make sure that you have some of those dollars that are going into maybe very safe places and other places that might have some additional high rate but big risk as well. Reevaluate your products periodically. So I encourage you every time you receive your statement, kind of look at it and make sure where it's going. And we'll usually list on there what your rates did for a certain amount of time in those particular products. So make sure that you're looking at that. And then determine your risk tolerance. And what I mean by that is nobody wants to lose money. I don't want to invest money and lose it. But I also know that if I left it in my savings account, it's not going to move very fast because rates are so low. So I need to make sure that I determine my risk. As you get older, your risk tolerance is not going to be very high. But at a young age, your risk tolerance can be much higher because you have time to recoup those dollars. So just remember that. Make sure that you consider what your risk tolerance is. We talked a little bit about the other investments as your home. So make sure that, as you're looking at your savings plan and setting up your financial goals, that you're putting some money aside so you can purchase your first home. Making sure that it might not be the dream home, but it's definitely a good investment for you. So make sure that you take a look at that as well. When we talk about saving for retirement, make the most of your remaining paychecks until retirement. Try to reduce or eliminate debt. So if you have some outstanding credit cards or some other debt that you need to take care of, make sure that you're getting rid of that. Because Stacy had mentioned this earlier. If you pay off a credit card or any bill, then you can take that money and reinvest it into maybe some sort of a retirement investment plan. So really take a look at that. And develop a plan to stretch your money through retirement. All of us want to be retired at some point, but we also want to be secure at that time and be able to do some things and live life to its fullest, I guess. When we're looking at decision factors on page 19, how much money do you want to save over time? Great question to ask yourself. Make sure that you figure that out. How long can you leave your money invested? So if you're in your 20s and you want to leave it invested till you're in your 60s, that would maybe be your time frame that you would leave it invested. And how do you feel about risking your money? Again, talking to a financial advisor, making sure that you're understanding and feeling comfortable with the risk that might be involved with that investment. Let's take a look at activity 2 on page 20. Here we're going to talk about determining what factors may affect your savings decision making and determining what short and long-term actions you might be taking. So when we look at this on page number 20 of your workbook, the top half of this page is really talking about your decision factors. So again, we're talking about the questions you need to ask yourself and how you feel about these specific things. So the first thing is, how much do I want to accumulate over a certain amount of time? Maybe using that Rule 72 to figure out, over time, I need to make X amount of dollars, I have this much to invest, what kind of rate do I need to have to make that kind of money? How long can I leave it invested? And we talked about that a little bit too. Is it short term? Is it long term? What are you looking to do? And it may be short term, because maybe you are in your 20s, but your goal is to buy a house in 10 years. So that would be a short term investment that you're looking for to save for a down payment on a new home. And how do I feel about risking my money? I know we keep saying that, but you really need to understand, how do you feel about some risk? And you need to be comfortable in knowing that you're going to probably have to take some risk in order to get some additional dollars and interest earned on those dollars. Then when we look at our action plan, what will I do now to save towards my goals? What can I do starting today? What can I do right now to start saving for my goals? Several times we've talked about the fact that when you get paid, take a certain amount, maybe it's 10% of your paycheck, and put it into savings. That way you don't have it right off the bat, have your bank transfer it, or you transfer it automatically. And it's a great way to just start savings right from the beginning. What will I do by the end of the month to save for my goals? Maybe I'll cut some expenses. Stacy told me that I needed to cut back on Starbucks. So if I cut back on Starbucks and on Friday night pizza night, maybe I only do that once a month. So then we can have some additional dollars that I can save at the end of the month and move it towards my savings goal. It's really important for you to really evaluate, what can I do to start saving money in another direction? What can I do with those dollars? I know I can do that. And what will I do by the end of the year for my savings goal? Is it paying off certain bills? Is it maybe not having any more, debt? Remember, I know many times as the new, and I use this example because like I said, I have 3 boys. And the new cell phone comes out and everybody gets excited and they have a cell phone, but they don't have this new cell phone. So everybody is like looking for a way to, I'm going to just trade my phone in and get a new cell phone. Do you really need to do that? Is your phone functioning? Maybe it doesn't have all the bells and whistles, but if you're really looking at putting together an action plan and a really good savings plan, reconsider what you're spending your money on. Reconsider it and make sure that you're really taking a hard look at that. It's going to be some things you might have to give up, but I promise in the long run, it's going to be well worth it.
So this brings us to the end of this course, and we hope you learned a lot. We covered a lot of information over this one. So we're going to move on to the post-test, and we'll kind of go over it and see what you've learned. So this is going to be on workbook page 21. So number 1, what are 3 benefits of paying yourself first? A, improving your standard of living. B, learning to manage money better. C, having money for emergencies. Or D, all of the above. And if you answered D, you were right, all of the above. Number 2, what is the major difference between saving and investing? A, most saving products are federally insured, while investment products are not. B, savings products have a risk of loss and investment products do not. C, investment products do not have as high a potential for growth in saving products. Or D, savings and investment products are the same. And the answer to number 2 is A. Most saving products are federally insured, while investment products are not. Number 3. If you get a tax refund, what can you do to make sure you save some of the refund? Select all that apply. A. Direct deposit some or all of the refund straight into your checking account. B. Deposit some or all of it into savings account with a higher interest rate. Or C. Use the money to invest in a savings bond. And hopefully you picked B and C. B, deposit some of it or all into a savings account, and C, use the money to invest in savings bonds. Number 4, which type of savings product, not including investment products, are available at most financial institutions? Select all that apply. A CD. B, a money market account. C, U.S. Treasury securities. Or D, bonds. And you would be correct if you picked A, CDs, and B, money market accounts. Number 5, you can save money by paying your bills on time because you avoid paying A, late fees, B, extra finance charges, C, disconnection and reconnection fees, D, cost of eviction, repossession, and bill collections, or E, all of the above. And I hoped you picked E, all of the above. Number 6, select all that apply. The rule of 72 helps you determine A, how long it will take for your savings to double in value with a fixed interest rate. B, the interest rate you need for your money to double within a set time period. C, how long it will take for your savings to double in value with a variable or adjustable interest rate. And the answer to number 6 is both A and B. How long it takes for your savings to double in value with a fixed interest rate, and the interest rate you need for your money to double within a set period of time. All right, moving on to number 7. Which of the following strategies will help you choose the best investments for you? Select all that apply. A, make choices based on a friend or family member's recommendations. B, limit the number of savings and investment options you choose to reduce your risk of loss. C, select savings and investment options according to your risk tolerance. Or D, consider how long you plan to keep your money in the investment. And the answer to number 7 is both C and D. Select savings and investment options according to your risk tolerance, and consider how long you plan to keep your money in the investment. And the last one is number 8. Which of the following are ways you can save for college? Select all that apply. A, you can build home equity, then apply for a home equity loan. B, invest in stocks, bonds, or mutual funds. C, establish a 529 plan. Or D, enroll in a 401k or 403 plan. And the answer to number 8 is A, B, and C. You can build home equity, then apply for a home equity loan, invest in stocks, bonds, or mutual funds, or establish a 529 plan.
And again, thank you for participating today in FDIC's Pay Yourself First. We hope that you got some great tools and ideas on how to invest and save for your future. Thank you again.
Thank you.